Welcome back. We are back with a second conversation with our guest, Kyle Taylor. He's with TriDelta Private Wealth, this time to talk about risks facing investors in today's market and two stocks he likes right now. Let's begin, first of all, with the market risks. But it's, today's a day when markets are surging higher. Today's the day when the S&P TSX Composite is trading at its highest level ever in its history. Is there a disconnect here? Are stock market investors too optimistic given the significant amount of economic uncertainty that there is around the world?
I would say I live by the mantra of be cautiously optimistic and you'll be well rewarded over the long term. And today is no different. I think there are risks that remain in the market. I mean, the tariff uncertainty persists. I think investors are, and myself included, are hoping that that tariff issue gets put to bed over the summer, and we can move on to other matters, and especially in regards to the tax bill that the U.S. just implemented, and that's been a major impact on the U.S. bond market and globally. Right.
Well, there are two very significant risks. I mean, I don't think the tariff issue is anywhere near being put to bed. Yeah. The tariff issue, perceptions of the tariff issue can swing onto whatever Donald Trump has said most recently, and the fiscal situation in the United States is very alarming in the view of the bond market as well.
Yeah, it's anticipated that the tax bill, if passed as is, would add between $3.8 and $5 trillion to the fiscal U.S. deficit.
Right.
And we're seeing the long end of the bond curve reflect that. And I think there's a risk, even, we were just talking about the banks, the U.S. banks have a risk there where all of a sudden they're seeing a longer duration mortgage book on their side because people are not incentivized to refinance at current rates. So it's not like in Canada where you have those 5-year terms. In the U.S., they have longer-term mortgages, and that carries some additional interest rate risk for the U.S. banks, which could come into play and be more of a story later this year and into 2026.
One thing stock markets would like to see is the U.S. Fed begin cutting rates. It has not done so yet. How do you think all this looks to the U.S. Fed, particularly this U.S. fiscal situation?
Well, I think you have to look at it from two different sides of things. On one hand, you have, is the tariff situation a one-time shock to prices that will elevate inflation, because tariffs are inflationary. The other end of things is, are the tariffs, they bring persistent inflationary pressures that the Fed needs to manage and get a gauge on. And if that's the case, then we could very well be talking about them raising interest rates next year.
Okay, let's move on to a couple of stocks you like. One of them is Spotify. That's not Shopify, but that's Spotify, the music streaming giant.
Yeah, Spotify has been an excellent growth story, and the reason I wanted to talk about it today is it's actually trading at its lowest valuation since before the craziness of 2020. It's trading about 67 forward earnings today, and although that may seem high, they're expected to grow 57% in 2025, 45% in 2026. They had a stellar Q1 earnings report in which they grew subscribers in what's historically been a seasonally weak environment or time of year for them. Sales growth in the mid-teens. They continue to be an industry leader, and we think they have a long runway for profitability.
Yeah. Is the space competitive? This is a similar question to the question that investors were asking about Netflix some years ago. Netflix has clearly emerged as the dominant player in that space.
Well, you'd have the main competitor, of course, being Apple in regards to the foothold they have on music and their step forward in podcasts. But really what Spotify has been able to do, it's much more customer friendly. And I think the price is very reasonable, and that's being reflected in a lot of their emerging markets that they've seen a lot of growth in. So it's a name that we really like. It's a name that we think will continue to be an industry leader and should reward investors.
I'm going to check the multiple that the stock is trading at right now. 67 times expected earnings. That's growth stock territory for sure.
Yeah, we certainly think it's a relatively fair valuation given their estimated growth for 2025, 2026, and beyond.
Okay, let's go to a Canadian stock in a completely different sector, Extendicare, in the retirement living sector.
Trying to trip you up here. Extendicare is actually one that I came here and talked about late April, and we had a price target for them at $14. I wanted to talk about it again because it continues to be a really great opportunity for investors, and we actually raised our estimate for $15 a share on the stock. They had a great earnings report. They had a really favorable Ottawa acquisition and the sale of a legacy asset in Ottawa. They grew the business across all three segments. They've been rather insulated from tariffs in regards to the demographics of an aging population are not changing. Their suppliers are predominantly Canadian. The one drawback could be rising build costs for some of the new assets that they're bringing online. But we think they're continue to trade relatively reasonable at a 16 times forward earnings, and they offer a 3.6% dividend yield at present prices.
You say their suppliers are prominently Canadian. That's the suppliers of things like food and supplies that the business needs to operate.
Yeah, any of the supplies that they use in their housing for their residents, as well as medication too.
This one trades at almost a 17 times multiple to expected earnings. What are your thoughts on that multiple?
We think it's pretty reasonable regarding the growth trajectory that they have. We think that even if there was a recession or some kind of economic downturn in Canada, the demographics just are not changing, that people will have a need for their services, and we think they're well positioned to capitalize on that.
And to be clear, is this long-term care or retirement homes, or both?
Both.
Right.
Yeah.
Kyle, thank you very much.
Thank you.
Kyle Taylor is portfolio manager at TriDelta Private Wealth. Up next.